So I said as we started this, hopefully you've printed out all the things that you need, the manner transactions, you have access to the chart of account rules, and then you have a journal sheet. So we're going to take the time to go through each one of the manner transactions, which will be practice from what you've done before, and hopefully those of you that still are struggling with what's debit credit, hopefully this will help. So we're going to start with the journal sheet. We're going to start with the first one. So just to break down again how this sheet breaks down. In here you'd write the month and then the day of the transaction. First transaction happened on August 1st. These next two lines are just for the information. This would be your debit and credit, these bigger lines. You have these small boxes here, so eventually when you post, you just check it off. And there's a lot of boxes in here, and this is where you want to put the numbers. The left side, remember, left means debit. So column 1 would always be your debit, column 2 is always your credit. All right, so we'll go through each one and see where it takes us. So on August 1st, the first transaction, we received office furniture valued at $25,000 in return for common stock. Let's look at the first line first because that's really the key thing. I'm not sure if I said this before, but I'll say it now. Accounting is not creative. Everything in the transaction basically outlines the accounts you need to use. So you got to look for key phrases. So in this first one, we see furniture and common stock. If you looked at the chart of account rules, you see we have an account for furniture, it's an asset, and we have an account for common stock, which is an equity. So the furniture in this case is going up because we're getting it. So our furniture account is now increasing by the value of $25,000. So somebody's giving us furniture. If we look in the column, since furniture is an asset, it's going up. The arrow points up on the debit side. So it's a debit. So you're going to write in this first line, furniture. And then over here, you're going to put in 25,000. Okay. Under double entry accounting, for every debit you need a credit. For that furniture, we gave common stock, which is an equity account going up, and that tells us to credit it. And it's the same amount in the column, so it's 25,000 over there. And then we want to list something. So we're going to say received furniture, okay. And in here we're going to put the second line of the transaction, 4 years life, and we'll depreciate monthly. So we're going to say useful life, 4 years. Hopefully if you looked at the PowerPoint, you know what useful life means. Anytime when you depreciate something, it has to have a value, how long it's going to last. Depreciation is the decline in value. Businesses like to take depreciation because it's an expense. It's an expense that they're allowed to record on a monthly basis or annual basis. And anytime a business records an expense, it decreases their profit, which in turn decreases their tax burden. So for now, we're just going to leave that and we'll deal with what the depreciation amount is later. But this records the transaction. Again, our furniture increased, so we debited it $25,000. Common stock increased, so we credit $25,000, and that gets us the answer. Our next transaction is dealing with prepaid rent. Prepaid rent is, as we can see, again, we prepaid 4 months' rent of $4,400. Prepaid rent is an asset. It shows up right there. It's in our asset column, right? And it is going up. Prepaid rent is essentially, it's an asset because if we are giving some money now for things that we're going to gain in the future, it's an asset because at any time we can cancel that future use and we can get money back. Assets, again, are areas where cash is available to you. Things that you can use that have that cash value that you can use at a given time. Cash, obviously. asset, any other prepaid rent. Again, this is something that you're getting that you can use in the future. The transaction says we paid it. We prepaid 4 months, gives us a value. So whenever you pay anything, you use cash to pay it. So we're going to go down here and we're just going to list a 1. We don't need to list August because it's already there. It's still in that same column, so we're good. We're going to debit prepaid rent. And that's for $4,400. And we used cash. And we're going to put $4,400 over on the credit side. And this is paid 4 months rent. It's important again to list the reason what you're doing, because we have to, the time value of money shows that we have to expense out that as the time comes. So again, the first 2 transactions deal with some of the adjusting entries that came up in the PowerPoint slide. So hopefully we'll go into more details. The next August 1st transaction is sold 60-day service contract on merchandise to Jordan Company, $1,200 paid in cash. So what's happening here is that the Jordan Company is buying a service contract. So a contract of service, and they're paying right now. So they're paying us $1,200 cash. So right off the bat, that should clue you in that we have a debit to cash. And that's for $1,200. Okay, so for that, we are promising to do service for the next 60 days. We haven't done it yet, but we're going to. So right now, we can't count it as revenue. If we were performing the service today, we can count it as service revenue, but it's not being done today. It's 60-day promise of service. Similar to the prepaid rent, we can cancel the prepaid rent at any time and get money back. They can cancel the service contract at any time, and then we would owe them money. Whenever we owe money to anybody, it's a liability. So we're going to use that count. We're going to look for our liabilities under our chart of account rules. And the one liability that makes sense is this unearned revenue, because it's money that we owe somebody service. We owe somebody revenue. They paid us up front. We received the money, we received the cash up front, but we haven't done the service yet. So it's owed revenue. So it's basically unearned revenue. So that's our credit. Because the liability increasing is a credit. So we're going to list that there, $1,200. And we're going to call that 60-day service contract. Okay. Next one is similar to what we did in July. August 8th, we performed service on account. So in this case, it's a little bit different because we already performed the service. But instead of giving us cash, we decided to allow them to pay us on account. So that's accounts receivable. Again, it's a debit to accounts receivable because it's an asset. It's money that we're going to get at a later date. It's for $6,000. So we'll go over in the column here and put in the 6,000. And it was for service that was performed. This time we can record the service revenue because we did the service. But instead of them paying us in cash, they're going to owe us. So this is performed service is the reason. Okay. August 12th. What's happening on August 12th is that company's now paying us half of what they owe us from August 8th. Well, they said on August 8th they owed us $6,000. We paid them on account. So since it was $6,000 on account, that's what they owed us. When we went to post that account, we would post that on our T account. So let's pretend this is our T account for accounts receivable. And it would show $6,000 there. And they paid us half. So now they only owe us $3,000. So if they paid us half and they only owe us $3,000, we have to somehow get this $6,000 down to a $3,000 balance. And the only way we can do that is to credit $3,000. So how do we record that? Well, we're going to go over here and we're going to put in August 12th. And they now gave us half of the money. So they now gave us money. So that's cash going up, which is a debit. And now they owe us less. So we got to take this accounts receivable and we got to decrease it. We decrease accounts receivable by crediting it. And an effect that creates that they owe us now only $3,000. And this, we can say half payment received or something to that matter. August 15th, August 20th, and August 22nd all operate the same. August 15th, 20th, and 22nd all involve different expenses that take place. So we're going to look at our expense category, and we're going to look. So on the 15th, we bought stamps. Well, stamps are postage, so that's postage expense right there. So postage expense is going to happen right there, and we paid cash. Doesn't say it, but it doesn't tell us we bought it on account, just gives it a dollar figure. You assume it's then cash was used. On the 20th, it says we purchased lunch for the office on account. Still an expense incurred. Lunch would be meals, so we would list meals expense. Okay? But on account, we didn't pay cash. So if we didn't pay cash today, we owe it in the future. It creates a liability, which in this case is accounts payable. And the last one is similar to one we did in July, where we paid the utilities bill. So we're going to look back at our expenses. We have utilities expense, and we used cash again to pay it. So that's the asset going down. Cash is a credit. All these require a debit to the expense because all these expenses are going up. 15th was postage, 20th was meals, 22nd was utilities. Two of them used cash. Cash going down is a credit. Opposite about going up, going down is the credit. And the other used accounts payable, which is also a credit, because we're going to owe it in the future. So let's record all these. So on August 15th, we have postage expense. Again, I recommend you used pencil because you always make mistakes. I know I've done it before. I've done it on video, so you guys can keep it forever, my mistakes, but pencil always works. So this way it's $49. $49. And this was bought stamps.